Hello, everyone, and welcome to the webinar. I apologise for the slightly late start this morning. If you've seen one of these before with me, you may know that this is a series of webinars exploring tax issues that affect businesses. So thank you very much for joining us today. My name's Amy Jack, and I'm a partner at Saffery. And today I'm joined by my colleague, Phoebe Hindlet, who leads our capital allowances team. And today we're going to focus on how to maximise the capital allowances that you're entitled to, and also how to reduce the risk of scrutiny from HMRC. And these two things are actually very aligned. The content is not specific to any one sector or type of taxpayer, and like our other webinars, should be really practical. So hopefully lots of good takeaways for you all today. Before I hand over, I've got a couple of housekeeping points that I just wanted to mention. The webinar is being recorded. It will be available on our website and kept for up to a year. No attendees can be seen or heard, and we would ideally love for you to submit some questions today, but due to the late start, we may not have a chance to answer them. But please do submit them and we will respond to them and share them after when we send the recording out. You'll always receive an email after the session with the recording and then any questions as well. So that's it from me. I will hand you over to Phoebe. Enjoy the session.
Thank you, Amy. And so thank you for your patience whilst we were just sorting out, of course, the trusty technical issues, which was what you always want when you're about to present a webinar. And Amy obviously gave an introduction. So I'm Phoebe Hindlet. I lead the National Capital Allowances team at Saffery. I've been doing capital allowances claims my whole career across Big Four and into consultancy. So I've been really grateful and fortunate to work on some fantastic and complicated projects, which is why we wanted to bring you this session today. As the agenda sets out, we're going to look at the budget and what's changed and why it matters, how to claim with confidence and some practical steps that really work, then into some sector deep dives and how to navigate HMRC scrutiny, and then looking ahead at what the future of capital allowances claims would look like. So hopefully most of you now would have seen the budget changes that came into force was announced in autumn last year. The main one being the introduction of the new 40% first year allowance, which came into effect from January this year. And that is the headline of that is that there is a new allowance that essentially bridges the gap between what was there and what was before, and it will also extends to leasing and unincorporated businesses, and that essentially fills the crack where potentially businesses weren't able to make use of AIA or full expensing. And I know for some of the clients that I've worked with, particularly on partnerships, where you could have a mixed partnership that obviously the corporate members could claim full expensing, and then they were not able to claim any accelerated reliefs at all because mixed partnerships can't also claim annual investment allowance. So that essentially tries to bridge that gap. And whilst they can't make use of the full expensing, and it's not obviously the same rate, it does help to bridge that gap between the two types of businesses. And of course, a welcome introduction for the relief on leasing as well. And outside of that, cars, second-hand assets and overseas leasing remain outside of the scope. Now, another sort of shift rather than an overall sort of introduction of any new reliefs is the reduction of the main pool writing down allowance. And that is from this month, from April 2026. And that is a reduction from 18% to 14%. And if your financial period spans the April 26 year end, then there will be a transitional hybrid rate that applies. And why that is really important is that you can, for a lot of businesses, there's a large main pool balance, which would mean there's ever sort of more of an increasing importance of claiming those first year allowances, because ultimately, from a timing point of view, if the plant machinery falls within the standard rates of writing down allowances, the relief is going to be offset over a much longer period. So as I say, really important to consider, okay, what have we spent last year? What are we planning to spend this year? How can we make sure those allowances are pulled at the right time to make use of the first year allowances so we don't fall within the lower rate of main pool relief? So what remains unchanged is the £1 million worth of annual investment allowance, 100% full expensing for plant machinery available to corporates, and 50% first year allowance on special rate pool, and the standard rate of special rate pool applies as well at 6%. So as I mentioned, why this matters for you and the kind of whole focus around this session today is there's a really great focus on timing and timing of your expenditure to make sure that you do pull things in the right place at the right time to make sure you're getting the most out of the release available. And with that, pooling accuracy as well. We see it quite a lot in practice that, for example, where there could be a package of electrical installations that are carried out or incurred, and on the face of it, the whole amount would be treated as for special rate pool as integral features. But within that, in the detail, there could be fire alarms or data or network or security systems that actually qualify as main pool plant and machinery. So you can see straight away that a proportion of that could be potentially moved into full expensing over integral features, which will straight away again give you that acceleration. So it's really important, not just the timing, but the accuracy of that pooling as well. And of course, with that, the optimization of historic expenditure, there's still a window to go back and obviously amend for any expenditure incurred in a previous year. So it's worthwhile just thinking, okay, what work have we done recently? What work are we about to carry out? And how can we make use of the reliefs since the changes in the budget? So claiming with confidence. I've been doing this role quite a long time, as I said, my whole career, and I would say that the whole premise around claiming with confidence kind of falls into three areas, and that includes and these are kind of all interlinked. There's no sort of one over the other, but the three key points to that is the timing of the claim, the information to do the claim, and the approach of doing the claim. So I think there's sometimes a common sort of misconception that you can do cap allowances, and you can do cap allowances when the project reaches completion or in line with the compliance cycle, which you can, and you can still approach the claim in that way. However, when it comes to that point, a lot of the time the contractor would have moved on, or information isn't as readily available. So trying to kind of do it retrospectively is sometimes quite difficult, and in order to get the information you need in a format that's required to do the claim in the best possible way is more difficult to do that once the project is finished. So I would say in terms of time, and early engagement is key, particularly while the project is live or even before that point. So if you're in planning, or you're about to sign a tender, or you've just signed the tender, we can, a specialist can get involved in that point to advise you what the format of that documentation should look like. Is it detailed enough to do the claim? And is all the information there that's needed from a technical point of view? So I would say early engagement is key where possible. And then with that, as I said, we can assess the quality of the information, whether it's in the right format. And also, is there any clauses that are needed in that contract? Is there a requirement on the contractor to answer the technical queries that are needed for the claim? And as I mentioned before, approach is also key depending on the type of project that you are undertaking. So is it a construction? Is it a refurbishment? Will a full cost assessment be required and a measurement of the building? And then there's a difference in approach between whether it's an acquisition of a property or a full construction of a property. So it depends. It depends what the type of project is and how, and then for the approach in terms of that, doing that claim. And in terms of timing, the main interaction will be from a compliance point of view, that you can prepare an interim claim as well. So whereby each financial period, an interim claim can be provided, and for that purpose can then be incorporated into your tax computation. So therefore, from that perspective, you are doing things on a yearly basis as the project progresses. And then once that reaches a final account, a claim analysis can be updated, and those numbers could be incorporated into your tax computation. And I think also that we have, what I've seen in practice as well, is that obviously from a tax point of view, we tend to deal with the finance team, and they have obviously all the records, the fixed asset additions, and what expenditure has gone through the accounts, and in terms of fees and things as well. But a lot of the time, the project day to day would be handled by the project team, if there is a separate project team, and there's the invoices for the valuation payments passed to the finance team. So therefore, there's can be a bit of a disconnect. Therefore, when it comes to do the tax analysis, so I would say if you have that kind of set up in your business, and again, a project is currently underway, or you're about to enter a project, perhaps have those discussions with your project team to say, yes, okay, we need the invoices, but we need the level of detail behind that as well, because we know when we come to do our capital allowances, that is what is going to be asked for. So as I said, I think it's those three things together. Of course, the main part being the entitlement as well, which actually isn't on this slide, but I think I added that in this morning. But yeah, of course, the most important part being that, of course, to claim with confidence, you need to have the entitlement as well to claim. So an interest in land, you've incurred a qualifying expenditure, and you are the qualifying person and have a qualifying activity. So there's various different entitlement points that would be covered off as part of a capital allowances claim and analysis. But between those three things, I would say would be key in terms of ensuring that you can claim with confidence. So I'm moving to the sector deep dives, and we wanted to focus around what our predominant client base is. So real estate and development, landed estates, and creative industries and hospitality. So as you can imagine, being in the real estate and development sector, of course, these buildings are, predominantly have fixtures and building services, and it remains a major opportunity for capital allowances, and one that we work, a sector I work heavily with and have done for many, many years. And what I wanted to cover, which again, some of you may have heard of, is actually a recent case that has sort of been to and fro the courts and appeal, and has recently been overturned. So it's the Gunfleet Sands case. This actually involves a wind farm, but very prevalent for large construction projects. And I know HMRC will be relying on this, across different sectors, particularly real estate. But what in this case, it involves the pre-construction costs and some assessments and studies that were required before the wind farm in this case was installed. And the initial argument was that these studies and assessments were required in the eventual installation of the wind farm. And as I said, these pre-construction costs were initially upheld, and then subsequently, as of late, they were actually overturned in the Court of Appeal, and HMRC won. And it's very interesting that the language on that one, and as I said, it will apply to many other real estate projects, because they essentially got to a position where they said that, yes, even though you've incurred this expenditure on studies and assessments, these costs weren't actually on the provision of the plant machinery. So it wasn't the actual installation costs. These assessments were needed, but they weren't necessarily required on the provision of the plant machinery. So it's a very specific wording, and I think it is going to cause some implications for many of our clients and other claimants. But I think it's just worth being aware of that particular case, because I know HMRC are going to be looking out for this and the treatment of these types of costs and other projects. So it's definitely worthwhile thinking about if you know you're going to be incurring substantial pre-construction costs. The other area that I see is up for risk and is particularly complex is where you have got a private residential sector building or student accommodation. So these are typically high-rise apartment blocks and have got communal areas. And there's also a common misconception here is that the communal areas are actually eligible to be claimed on. So that's essentially the landlord retained areas. So that the dwelling areas are normally ineligible, but the communal areas, that's the plant rooms, the hallways, landing stairs, lifts, etc., can actually make a capital allowances claim on those areas. And it is complex because we have to consider what is in or out the dwellings. That includes the services and what sits in or outside those dwelling areas. And of course, because typically for that type of project, a cost assessment is required. So it can be up for potential contention and risk. So it needs to be undertaken by a reputable specialist. So I wanted to mention that one because even though the quantum of allowances can be on the lower end, over a multi-million pound build on a project like this, that the allowances can still be substantial. So it's definitely worth thinking about if you work in that sector. And of course, when it comes to real estate, the buying and selling of properties and transactions all happens all the time. And there is sometimes missed an opportunity on capital allowances, particularly if you're selling a property, have you optimized your position before you sell the property? Are you going to negotiate over the capital allowances in order to retain some of those allowances, or are you going to use it as a negotiation tool with the buyer? So I think sometimes capital allowances can be a bit of an afterthought on a transaction, but I think if you are, again, using a reputable advisor, they will point that out as an area that needs to be given special attention, particularly where, elections are concerned. And with all things, like I mentioned before, to do this on a live basis is key whilst the transaction is going on. Yes, you do have 2 years to agree that election, but it's much easier to do that whilst the project is and transaction is live. And in the last few years, from 2018, the structures and buildings allowances regime and relief was introduced, and that also needs to be considered when you're selling or buying a property, because the fixtures is covered in the election. The chattels are normally separate, so your loose equipment's normally separate, and then you have any structural and building elements that should be included as part of an allowances statement. So if you are buying a property and they've incurred expenditure in the last couple of years, there is likely to be SBA type expenditure. So I would just ask the question, are we going to be getting the allowance statement, because that relief should automatically be being passed over the balance to you as the new owner. And along with that, the last point on this particular slide is purchase price allocation. So if you are going to be doing or looking at a purchase price claim, an acquisition claim, where it is established that there is entitlement to do a claim and the previous owner didn't have any entitlement over the capital allowances, obviously there is entitlement piece to do there separately. But there is an allocation that needs to be done on purchase claims between the building and the land and the fixtures. And again, that's done on a cost assessment basis using surveying cost assessment and reconstruction. So that again can only be done by a specialist, because those particularly purchase price claims are open to scrutiny from the revenue. So a proper methodology and entitlement procedure needs to go through for those particular claims. So landed estates and rural businesses. Saffery, I've got a very good reputation for looking after this sector. We work with a lot of landed estates businesses, and I think on the face of it, sometimes, definitely not for our clients, but for outside of our clients, that the sort of interpretation is, oh, okay, it's a farm. What is there? But of course, it is landed estates and rural businesses is much more than that. Is a wide range of qualifying assets across the estate portfolio, and of course diversified trades within that. So it's not just a farm. There's normally a considerable amount of commercial buildings that are part of that trade. So what I've got involved with recently is things like large commercial greenhouses, packing warehouses and packing lines, where there's quite a significant spend on the construction of these commercial buildings that have got very high spec and trade specific equipment. So it's definitely worth thinking about. If you know that you're spending money on your farm on these types of assets, then capital allowances is still very relevant for you and should be be considered, because again, with the full expensing and things like that, it can be very beneficial. And then, of course, you've got the farming and non-farming activities. So it's making that distinguishing between those two types of activities. So I know from the clients I work with, quite a few farming properties have holiday accommodation on the land as well. And up to a few years ago, you would have been able to claim what was as furnished holiday lets, but that relief was actually taken away, and that now falls, that type of expenditure now falls within the of the standard property business. So, you know, previously you could get cap allowances on a furnished holiday let, but not unfortunately anymore. But there may be an opportunity if you're incurring a lot of expenditure on repairs and renewals. It's worthwhile thinking about whether a capital and revenue exercise needs to be undertaken, just to ensure that the repair type expenditure is getting the relief it should be, being that it's revenue in nature. A lot of the work I've been doing recently for this type of client as well is on specialist assets. So as you can see here, biomass and CHP systems. And I think on the face of it, there may be the interpretation that these are kind of like an easy win and quite an easy to categorize. But it very much depends on how that asset is being used in the business, what the function of that piece of equipment is. You know, is it being used for general heating, or is it for that business a particular trade specific asset? And where it's come up in the clients I've worked on is where they have to environmentally dispose of the poultry waste and things like that. So we've had to look at that, you know, what is the primary function in that business? Is there an argument to say that actually that equipment is being used for that versus as a heating system, which would be an integral feature? So as I said, it's not a clear cut for each client. We have to go through the different thought processes and case law for each client's set of circumstances. But it's worthwhile just, again, thinking about if you've spent money on this particular type of equipment, how has that been treated? It may be that you made a claim, but have you made the right claim? And could you be open to risk if the proper facts haven't been considered? And with that, we have to look at the long life asset treatment as well. And in the cases I've worked on, we consulted a specific engineer that looks at this as piece of equipment to determine whether the assets were going to have a useful economic life of longer than 25 years, which again would alter the treatment. But things we think about is, you know, design life, changes in technology, just to see if that will have an impact on the treatment. But as I said, it's not, you know, there are significant opportunities that sit outside the headline plant. It's not just tractors and equipment. There's usually a lot more than that that can be considered. So definitely worthwhile if you're spending money in that sector. So I've worked a lot with creative industries and hospitality. So things like video games providers and studios and quite a considerable amount of hotels as well. So I have a lot of experience in this area. And of course, as you would expect, these are very fit out heavy type businesses, but not to say again that they can't be complex, because it's a different lens you have to look through for each type of client. And for these particular type of clients, there's a lot of trade specific assets. So things like sound insulation and decorative assets, particularly for hospitality, but it goes beyond the obvious equipment. And yes, of course, you've got the fixture fittings and finishes, which you would expect in this type of properties, but it goes much more beyond that. So in a hotel, as I mentioned, sound insulation for both types of businesses, but in a hotel, obviously they have to incur a significant amount of spend for sound insulation so that their guests can have a restful and peaceful night's sleep. It is trying to identify what is the extra overcost outside of the main building structure. So it's not an easy thing to identify. We have to go into a lot of detail and through our site inspections to identify what those costs, that over and above costs, are. And as I mentioned, things like decorative assets in a hospitality sort of environment. So that is things like artwork and specialist finishes and all the things that are, again, over and above what would be seen in an office or industrial unit, for example, where they've clearly been installed to create an ambience. And I've also claimed in the past decorative assets on high-end retail as well, because they're very much, again, in the business of attracting customers, because it is part of their business model to attract customers to their store. And as I mentioned, with creative industries, of course, lots and lots of trade-specific assets that, again, we can confirm that there is a specific function for that business to be claiming those over and above costs compared to other claimants. So I think the biggest question I get asked, and obviously why this session come about, is because ultimately clients want to optimize their risk, but of course they don't want any HMRC scrutiny. Now, I think that's a fair position to be in. You want to claim everything you're entitled to, but also don't want to raise any red flags. And I think that's a very fair point to make. And as I speak to many clients, we're in the position that, of course, we don't want to raise any red flags either. So it's about optimizing claims in the right way and making sure they can be supported, and you can stand up against challenge. And what we're seeing now, and what HMRC are focusing on now, and what I see actually from a slightly different lens when I'm undertaking a PCRT review, and we have to do theirs where in different sort of circumstances where different advisors are perhaps doing the cap allowances and then feed into our compliance team here. And what I see quite consistently is inconsistency across the tax filing and the statutory accounts. So we can see that a cap allowance claim has been prepared. They have reconciled to the main contractor schedule, but then in terms of what has then gone through the fixed asset additions and the statutory accounts, there is sometimes a disconnect, which can mean for the compliance team here, it can be quite a bit of a headache, because there needs to be an adjustment or an unreconciled balance that then needs to be put through to make sure those numbers then tie back to the stat accounts. So I think particularly if you are involved with other advisors, I would just make that a point of contention to ensure it does reconcile back to the statutory accounts, because I know from the claims that we prepare, the numbers can be pretty much just picked up from the report and plugged into the tax computation, so it's quite seamless between the two. So whatever's gone through your fixed asset additions is what is in the claim report. So I think if that isn't being done, I think that having those sort of unreconciled balances are going to provide some level of risk and unnecessary questions, perhaps from the revenue. I've also, and I don't know if it is relevant for any of the clients on this phone call, but what I've seen in practice is some of my predominantly retail clients that have had historic sampling agreements. So where they've done a cap allowance claim on a basis of, say, 10 projects, and then those results then applied to the wider portfolio. And I know back, a good sort of 5-6 years ago, that was the norm, particularly where people had sort of several stores that were quite similar in format. But what that does mean, if you have, and what we did see looking at those sampling agreements, is that often where there was changes in the relief, the sampling agreements weren't being updated. So there was a disconnect again between what was able actually to be claimed and then what they was claiming in practice. So in those instances, I moved a few clients away from a sampling agreement into more of a live data-led analysis, which the revenue did actually write to a few of those clients, suggesting and encouraging that they moved away from a sampling agreement. So I think if you're on one of those sorts of agreements where you're not doing a claim on a live sort of real data basis, then I would suggest that perhaps that needs to be looked at, because I know it has been encouraged. I've also seen instances of clients receiving letters from HMRC where they are claiming annual investment allowance, particularly if it is within a PE fund. And what we're finding is that there is actually legislation that if you are in a PE fund, and under common control, And there are different tests that need to be considered for this allocation. But if you are part of a PE group, the AIA should actually be split. I say, depending on the tests, should be split over the PE group where there is common control. And we are seeing instances where a full AIA allocation is being made in one company, even though they're part of a PE group. So I would just flag that if you know you are in a PE group and you haven't had that conversation around AIA, then that should be one of the things that you need to consider and try and resolve so that you are not open to risk. And I think ultimately HMR scrutiny would only come into play where you don't have a supportable claim. You know, if you're having a claim prepared by a reputable specialist who has a full backing of the entitlement, the claims that have been made, how those decisions have been arrived at, and what the technical basis is for those decisions, because that is it. It's all about showing the rationale. It's not just, oh, we've spent this expenditure. It's why have you spent this expenditure, and how does it meet the necessary entitlement conditions as qualifying expenditure. So it's all about having that supportable evidence. And as I said, from a purchase claim, an acquisition claim, where it is on more of a cost assessment basis, and it's making sure you've got the methodology and your how you've done that valuation, again, all fully supportable. So looking ahead, the future of capital allowances claims, and that's obviously quite a hard one to predict. You know, I haven't got a crystal ball, but if I did have a crystal ball, I think, of course, the main aim of this government is growth, and I think that continues and will be continuing to be the main focus for quite a considerable amount of time, being, you know, everything that's going on in the world at the moment, and investment and things like that. So I don't think there's going to be much change in terms of that agenda. So I think that would be a continued investment incentives. I think full expensing, obviously, it's been made permanent, but I can't see that going anywhere anytime soon. But of course, with that, another part of the agenda is energy efficiency. And, you know, a few years ago, we did have the enhanced capital allowances as available on energy efficient technology. But from doing those claims at the time, they were quite hard to do. And I think they obviously stripped that away because there wasn't as many people claiming as they would have liked to. But yeah, trying to prove that you met that eligibility criteria was quite difficult. But it would be good to see some other incentives for green technologies and to boost sort of sustainability agendas, because I know, again, a lot of clients are spending money on energy efficient buildings and BREEAM recognition and things like that for their buildings. So it would feel like there'd be, you know, a good thing to introduce. I think the revenue will, you know, they've got a great amount of data at their disposal to risk profile claims. They've got hundreds of claims, obviously benchmark now across a various set of advisors. So I think they will just continue to use the data they've got and the technology that they're developing to risk check claims. Obviously, we've seen it with R&D. It's not to say they won't do the same for capital allowances, but I think in comparison at the moment, they are relatively low risk. And of course, if you have got a supportable claim, if they are going to ask questions, then you've got the evidence there to support it. And I think undoubtedly the biggest change is going to be technology and AI. We at Saffery are starting to use, you know, tools and AI just to do some of the admin processes and things like that, and develop some of our own categorization tools. And you would have seen others in the market that are doing the same. I think there still needs to be an air of caution, particularly if an advisor's saying to you, oh yeah, we stick the whole sort of capital allowance claim through AI. I don't think that's the right approach to take. I still think there needs to be some level of caution, because I think the same. We see instances in practice where we ask, you know, quite a basic legislative question, and it still sort of points us in the wrong direction. So, you know, I don't think we're at a place yet where a whole, and I don't know if we ever will be, and I don't think that's the intention, that, you know, for this to replace what, you know, the years of experience that specialists have got. But yes, do I think there's tools that will make things a bit quicker from an admin perspective, potentially. But as I said, I think there needs to be some caution there, because ultimately wherever you use any tools. There is an element of risk that can't be ignored. And I think lastly on this slide, there's an ever increasing importance of joined up tax, accounting, and legal advice. I think particularly on transactions where a lot of the time these sort of advisors are seen to be in solos. But ultimately, the lawyers will be involved in how the transaction is put together from a legal perspective, and what conditions need to be foreseen at that level. You obviously then got the tax advisors that need to think about the whole tax profile and how that's going to affect the transaction. And then, of course, the accountants that in the day-to-day business and have the business knowledge from an accountant point of view. But ultimately, the accounting will impact how the tax is looked at, and the tax position ultimately can affect how these things are drafted from a legal perspective. So I think the three sort of advisors working together is key, say particularly on transactions, just to ensure that you are protected and you are in the most optimal position for your business. So what to do next? I think there's, as I've mentioned from the budget updates, I think there's an ever increasing importance to review and think about your cap allowances on a more of a live basis. I think they're, with the amount of things that finance teams have to think about, of course, this is one, and I know from practice, cap allowance is one of the things that sometimes can be left to the nearer end of the pile. But I think in terms of maximising your position, obviously cap allowances are still one of the most beneficial tax reliefs, and it's the only tax relief on capital expenditure in the UK. I think making that one of the priorities, I think, would be key. So I think as a next step after this call, it'd be really great if to review your upcoming and historical capital expenditure. So what have you got planned for this year? What did you incur last year? Has that started to be looked at yet? Is there a possibility of going back to make sure, if you haven't claimed any first year allowances for your previous year tax return, is there a chance to amend that to make sure you make use of those accelerated reliefs before then it falls into the low rate of main pool plant particularly? And I think there's an opportunity to stress test the finance processes, as I mentioned, just to ensure that you've got the right information, so that you've identified there's some expenditure that's been incurred, but then have you got the information to back it up? So it's a chance to stress test what process do we have in place. If you have a project team that's sitting over here, what information do they give us, and do we need to ask them for more? And then it's really important, as I mentioned, to build in cap allowances into your transaction and project planning. Yes, these things can be done at the end, but ultimately it's going to be a lot harder to get information and a lot harder to get answers to queries when contractors have moved on, particularly, and also from vendors if you're buying a property. So early engagement is key, and seeking specialist input early to avoid costly corrections later. I hope today's session was useful, and it gives you some ideas of the sort of things that you need to be thinking about to ensure that you're optimizing your position, and to think about ways in which you will need to avoid any risk. And of course, if you've got any specific projects you'd like to discuss, please feel free to reach out to me in the first instance, or to your normal Saffery contact. But I will hand over to the team if there is any questions. Any questions? Okay, looks like I've got one. So the question is, we are a tenant and we've had a landlord contribution, and can we make a claim? Okay, this is an interesting one. So I think there is a misconception sometimes that a tenant can't make a claim. And if you've obviously got an interest over the land and you've incurred capital expenditure, then yes, you can make a claim on your expenditure. The only part is that um, if you've received a contribution from the landlord, then you'd need to have essentially deduct that against the cost of the project. So then you're just claiming on the element that you've essentially incurred. So you would just have to take that into account. But what I would suggest is that there is a clause in the lease agreement, essentially just setting out what the landlord intends to, obviously what they're paying for, and then how the capital allowances needs to be allocated. So I would just ensure that the lease agreement completely stipulates that, and therefore then you're in the right position then to make your claim. What else have we got? Okay, so another good question. Okay, yes, another good question I've got here is when do you get a specialist involved, and what is part of the compliance and what isn't? So that's a very good question, because I think sometimes, again, it's knowing sort of what a compliance looks after, and then what a specialist needs to look after. What I would say is from what I've seen in practice, typically the compliance team would look at your sort of more routine sort of plant and equipment. So if you're spending money on, computers and furniture and more like one line items, if you've installed a new carpet and you can clearly see what that expenditure is, then that is typically what the compliance will cover as part of doing the tax computation. And I'd say sort of more sort of small refurbishments and repairs the compliance team will look after. But I'd say anything upwards of sort of £500,000, where you're getting into sort of a real detailed contractor breakdown, where you've had to go and get invoices from here, there, and everywhere. I would say at that point it's probably where a specialist is involved would need to be involved, because at that point it's where we start thinking about cost assessments. It's where there's more sort of reliefs in play that therefore would need to be sort of considered in the round to make sure you get the best outcome. And I think normally the compliance team are quite good at saying, look, we've done all we can do, but we think now, because of the quantum involved and the value, that it should be looked at by a specialist. So I hope that helps. Okay, just look another question. Yeah, so I've got a question about the detail and the invoices, and I think that's part of the issue, is that the invoices aren't very detailed at all. So it's normally the finance team will get an invoice that says, valuation payment one, for example, and then it's the detail behind that then we'd need. So it's the actual contract sum breakdown is typically called, or a cost plan. And it's that sort of level of detail we need. So I think that's where the sort of, it needs to be more joined up from the project team and the finance team, just to make sure we've got that level of detail behind the invoice in order to do the claim. Oh, this is an interesting question. So if I was a chancellor, I definitely don't want to be. If I was a chancellor, what would be my capital allowance policy of choice to support investment? I think the one I mentioned earlier. I said I know a lot of my clients are spending money on energy efficient technology. They are trying to make their, A-star sort of BREEAM rating buildings, and that is a lot of requirements, especially of landlords with their tenants. Their tenants want that level of energy efficiency in their buildings. And yes, we're getting the full expense on plant machinery, but there's nothing really. Yes, we get the 50% integral features, but there's no sort of real other encouragement to say to really encourage people to invest in the green energy efficient technologies. So I think for me that would be my policy of choice, if to support investment, if I was chancellor. I think we've got time for just one last question before we have to wrap up. And the question is, could I just drill down into the challenges around a new poultry unit on a rural estate? So yeah, so we deal with these quite a lot. There is exemptions on some of the things you can claim in on the poultry unit. So I think the main, also the thing that from memory, the feeders and things like that are eligible. But if you've got the structure itself, that is non-qualifying. So it's or under structures and buildings allowances. So we do have to go through the exercise of splitting out those different elements. But say equipment is normally okay, but it's the structural elements are not eligible for plant machinery anyway, but can be looked at for structures and buildings allowances. I think that's all of our questions. So I want to thank you again for joining me today. If we didn't get time to get to your question, so please feel free to contact me, and I'll hand over to you, Tracy, to close it off. Thank you, everyone.